Hi everyone, welcome to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wainman. Before we get into the company Activision Blizzard that we're going to be looking at, don't forget to like, share, subscribe, especially as you will see later on, if you requested us to analyze a company as a subscriber, you will get instant notification of when we publish this. Now, the point of this podcast is to help you, no matter what you do, to become more proficient at understanding finance, right? So it is money makes the world go round. And as Warren Buffett said, if you can't, finance is the language of business. So it stands to reason, if you cannot understand the language of business, then you cannot really do business very well. So whether you are an investor who's looking at improving their investment thesis, or if you're in sales or in business in general, and you're looking to sell your products and services to someone, you better start knowing about the finances of those companies and what story they tell. So let's go into Activision Blizzard. Very well-known company, so not too much of an introduction, really. They're a games development business, and they are both in the S&P 500 and the Fortune 500 companies. So it's probably one of the largest, if not the largest, video game company in the world. And they are the creators and owners of very well-known games. So they own King, which develops Candy Crush, Call of Duty, Diablo, and various other games as well. So very well-known company. We did get this as a request from one of our viewers. So the name popping up now, as you will see. So Ayan Ahmed, here is your analysis, and interestingly, he feels that this is an undervalued business. So we will come on to the share price later on, because they've been in the public market since 1993, and if you invested in them back then, you would have certainly seen a good profit. However, when you zoom in, it tells a different story. So the last 5 years has been a roller coaster, and in the last year, actually, they've been on a decline. So we will talk about that later on, and talk about that in terms of the context of the financial analysis that we're about to take you through now. So Ted, let's take it away. I'm really looking forward to this one, since I'm quite a big gamer, and interested to see what the finances say about this company.
Excellent. Well, good to see you, Moeed. Yes, thank you very much. I'm afraid I have played Candy Crush in the past. I have never played Call of Duty. I think my kids are more into that than me. So anyway, let's jump in straight to the numbers. So we're going to look, first of all, we're going to look at their annual report. So this is the sort of formalized audited figures from 2020. Now, I know that that's out of date. We're now in December 2021 when we're filming this. So we are going to look at that, and then we're going to bring you up to date with their third quarter figures as well, and see how the business is actually performing. So these are the audited figures. You can see things like Call of Duty, Candy Crush on their front page, but we unfortunately are going to leave the pretty pictures behind and go through to the numbers, which is of greater interest to us. So here come the numbers. Let me just find those. And we're on to the income statement here, first of all. So we're looking at 2020. That's the left-hand column. We are dealing in millions. So net revenues, total revenues, $8 billion. So they're making a revenue of $8 billion. That is up from the previous year of 25%. It's a little drop, actually, from 2018 to 2019. So maybe there's a kind of, that's kind of reflecting the bouncing around of the share price. But the revenue is up 25% from 2019 to 2020. We then got the costs, and I kind of divided these out. So if we take these numbers here as the cost of sales, then they're operating at about a kind of 58% gross margin, and then down the bottom we've got the cost of actually running the business. That's the SG&A and any restructuring costs as well, which they seem to be doing a lot of restructuring on a very regular basis, surprisingly enough. And if we take out all of those costs, then they're on about a 40% operating margin. Okay, and then we kind of expect that. This is a technology company, so they pay a lot of money to develop Call of Duty. They then get it out there, and once it's out there, you know, if you buy a Call of Duty, it doesn't cost them anything because they've already developed it. So sort of a big amount of investment going on, and we can see that this product development, they've actually highlighted and said, look, we want you to know that, you know, this is the product development of the future, effectively. So there's an argument that says actually we should take that, what we call below the line rather than above the line, and include that with the cost of running the business. So big investment in future games, you know, $1 billion in the kind of, you know, the next, and that's really what these guys will be priced on. So you know, the kind of the game of today is not going to be the game of tomorrow. I grew up with things like Snake on my Nokia, and clearly that's not a kind of a big game these days, or Pac-Man, for example, although, you know, I'm sure there'll be a few people will tell me that Pac-Man is making a resurgence or never went away. But yeah, very much investing in the future. So you know, really bottom line, very little debt, a little bit of interest sitting there. So they got a little bit of interest, a little bit of debt, but very, very profitable. So there you go, $2 billion profit, up from 1.5 billion the previous year, which was in fact a little fall on the year before because of their fall in sales, but still 30%, more than 30% net margin, very, very profitable indeed. So income statement looking pretty good. Let's go and have a look at their balance sheet if we can find it. I think the balance sheet is just before the income statement. Here it is. So in terms of their balance sheet, the first thing we notice, so they got 23 billion of assets, and they are stuffed full of cash. So lots and lots of cash with a little bit of accounts receivable. And then what else have they got? They've got you know, really in the rest of their assets, they've got lots of goodwill. So that goodwill will reflect the fact that they have grown by buying things like King, for example. So when they bought King, they paid a big price for it. What they actually physically got in terms of the assets was a couple of blokes in mum's attic and their laptops, and therefore it will have been all goodwill, which is not a problem because they're buying the future or the future potential income stream, but just to recognize that. So that 23 billion of assets, about 10 billion is goodwill, almost half of it. So, you know, 10 billion of goodwill, 8 billion of cash, and a few other bits and pieces in there as well. On the liability side, you know, really very low liability. So look at this, you know, the current liabilities is incredibly low. You compare the current liabilities to the current assets liquidity, just not a problem at all. What is interesting is that not only do they have their kind of usual accounts payable, which is almost nothing. So looks to me, if you're supplying this company, they got so much cash, they'll just pay your invoice on time. They're really not interested in messing their suppliers around. And also we see this number here, 1.7 billion of deferred revenue. That's a revenue that they've received that they haven't yet earned. So this will be, you know, people subscribing to their games, you know, they're buying the actual games, but then they're subscribing, paying subscription fees, and they pay them in advance. So they pay the subscription and then they get provided the service. So this really helps the company's cash flow. We'll see that in the cash flow, but also is why they are stuffed so full of cash as well. They do have a little bit of debt, not a huge amount, 3.6 billion. So relatively speaking, it's not an issue for these guys. You know, they can easily afford it, very profitable, and the cost of that debt is relatively low. But they are mainly funded through equity. So while there is a you know, little bit of debt funding the business, it's mainly this 15 billion of equity, and this 15 billion of equity, a lot of investment by the shareholders, and then the retained profits. But this retained profit of about 10 billion, really what we should probably be doing is actually reading it together with these the number above, which is the treasury stock. So that 10 billion, that 9.6 or 9.7 billion here, so this is the total amount of profit the company has made ever since it started trading and not yet returned to the shareholders in the form of a dividend. However, what it has been doing is share buyback. So that treasury stock is you know, again, an opportunity for them to buy their own shares. You'll notice that they haven't been doing any share buybacks during the year, but certainly in the past, it's another way of getting money back to the shareholders through capital gain rather than through dividends. So there is the balance sheet. So balance sheet basically looking really very, very strong balance sheet. No issues there. We've got a little bit on the movement in equity. Here it is. And you'll just notice that these guys, they are, let me just make that a little bit smaller so we can see that. Here we go. So what we can see here very obviously is that they are paying out dividends. So there's the dividends. Each year they are paying out dividends. So these guys are a dividend payer, and we'll expect to see that in terms of the share price in that little dividend yield indication. So you will be getting a little bit of income from these guys, but they're really there for capital growth. Here's their cash flow. So yes, they are profitable, 2 billion, and yes, they are generating cash as we expected. So lots and lots of cash generation. Little bit of investment. Interesting enough, this investment is really down to we need to sort of take these two numbers here, which is the buying of mature for sale investments. Basically, that's just parking cash in a savings account. That's the way to think about those two numbers. So here we can see the capital expenditure, pretty small for this company, capital expenditure, because they don't really, they just need nice, good top of the range laptops, and that's about it. So they don't need property, plant, and equipment and machinery, etc., etc. So a little bit of investment, which is fine. And then down the bottom here is their financing. And we notice that, for example, they are doing a bit of refinancing on their debt. That's these two numbers together. And you'll notice that their debt has gone up. So they are doing a little bit of refinancing, but their proceeds that they get from borrowing money is greater than repaying the money. So they've gone up by about $1 billion. Again, not a problem because they can afford it. They're paying out those dividends, so a little bit of income coming the way of the shareholders. And on a net basis, they've raised a bit of extra cash by just borrowing some more because they can, because it's cheap. And they've got just lots of cash sitting on the balance sheet, and that balance sheet, that cash gives them opportunity, because if they see a gaming company that they really like that fits nicely with them, they can move very quickly. They got 8 billion in cash, they can just buy them just like that. So there's our annual report and account. So all looking pretty good. Let's just jump forward and look at the latest set of numbers. So here we go. This is their 10Q. So the 10Q is the quarterly report, and this is for the six. This is for the 9 months. My mistake. So the 9 months. So we're interested in this. We're going to be looking at this column here. This is the 9 months for 2021. They also give you the 3 months as well if you're interested, so you can kind of do that analysis, and they're comparing the 9 months, the first 9 months of 2021, comparing it to the first 9 months of 2020. And again, back of an envelope calculation, we take the net revenues, we divide it by 3, multiply by 4, so we kind of uplift it by 3/4, and that gives us an indication of where they might end up. And if they continue at this, they're going to end up with about 8.9 billion of sales, which will represent a 9% increase on 2020. So sales will be going up 2020, up by about 9%. They just scrolling down a little bit. Hold on. So again, still very, very profitable. They're still maintaining their 32% margin, so it's 27% in 2020, 32% for the first quarter. The gross margin is steady at about 60%. The operating margin is going up, which means that they're getting their fixed costs under control and improving profitability, and therefore their net margin, the bottom line, has gone up from 2020, 27% up to 32% in 2021, and they should be able to maintain that. So it's looking, again, just it's growing, it's profitable, it's ticking all the right boxes effectively. That's looking pretty good. The balance sheet, not a lot of change. Oops, we go up to the balance sheet. Here we go. So not a lot of change. Again, what do we see? We see companies stuffed full of cash, lots of goodwill. It hasn't really changed there. Quite a lot of debt. and the rest will be funded through equity. So, you know, you can see there's the 15 billion that we looked at earlier has now gone up to 17 billion in terms of their equity. Share buybacks, they're not buying back any more shares. They've made a lot of, you know, that profit that they made for the first 3 quarters. You know, again, most of it's been kept back in the business. Some of it's being paid out to the shareholders. So our summary is, you know, from a financial perspective, you know, if you like the games, fantastic. If you like, you know, but, you know, in terms of the company, this is absolutely rock solid, you know, very profitable, lots of cash, very strong balance sheet, you know, lots of cash sitting on the balance sheet, lots of cash generation, lots of flexibility, little bit of debt, but nothing to worry about. You know, and again, you know, very, very solid company. However, as you know as well as I do, that you know, when we're pricing a company, we're pricing it on the future, not on the past. And we mentioned the share price, so let's look at it here. So yes, if you had invested back in 1993, if you had that kind of vision that the guys were going to win, then you would have made a lot of money, and they have been bouncing around. So again, maybe the timings aren't exact, but you can see that you know, towards to 2000 and end of 2018, a big old drop. And maybe that's where we see, you know, the drop in sales 2018 to 2019, and people say, okay, so people have stopped playing Candy Crush, they stopped playing Call of Duty. These guys are yesteryear, they're kind of the Pac-Man of the past. You know, no one's going to be buying them, and they've kind of defied their critics and pushed back up again and said no, and then they're all back up again, and suddenly they're back down again. And so our request is, are they undervalued? So let's look at their valuation and some of the key metrics. If we look down the bottom, highlighted for us, the market cap is $48 billion, $48 billion on a net book value of, you know, the balance sheet is about 17 billion. So they are, you know, 183% trading at 183% premium. You know, they're also, you know, over 2 times you know, over 2 times you know, the actual book value. But again, if you buy a company like this, you're not buying the assets, you're buying the ability to generate. And don't forget, lots of that asset is goodwill anyway. In terms of their earnings, we've got about 18 times earnings. So just so that we understand that, if you flip that upside down, so that's the price to earnings ratio, that's the 47.9 billion over the earnings of you know, predicted earnings. You know, I reckon predicted earnings are about 2.8 billion, and therefore they're you know, on a sort of forward looking PE ratio, they're about 16.8, so nearly 17 times earnings. So that's the price to earnings. So if you flip it over and you say earnings to price, you're getting at about a 6% yield. So, you know, would you buy this company on a 6% yield? You know what, the US is trading on 30 times. So the CAPE, the cyclically adjusted price to earnings ratio, is 30 times. There's a lot of technology companies that are trading even higher than that. Facebook's on 30 times, for example. Tesla's on crazy multiples. So these guys, they do look a little bit neglected. I mean, you know, 18 is not cheap. It's not a screaming buy. Remember, we looked at Lloyd's Bank, which was 7 times earnings. So these guys, but they are, you know, 18 times is not that bad, and you are getting a dividend. It's a small dividend yield, but then the dividend is relatively small. But if they can't think of anything better to do with that cash, maybe they will start to think about returning it. I'll run a few other ratios. So what's also interesting about these guys is, if we look at the, you know, we can, this is the PE ratio. If we look at the PEG ratio, so I'm just going to pull out some of this this analysis onto the screen. So these are some additional numbers. Let me just clear my annotation. Here we go. So what we've got here is, so these are some of the valuation metrics that I run. So just so we're clear, there's the price, there's the earnings. The price to earnings ratio is about 17 times earnings. So obviously they're actually quoting 18 times, but you know, I'm looking, this is my forecast, so this is just, you know, taking the net profit figure for the year so far, and just you know increasing it by you know, a quarter. So there's my 6% yield. Dividend yield is very, very small, but then they're only paying about a small dividend. I don't think that's a major problem. And there's no additional share buybacks going on. What is quite interesting is, down the bottom here, a few other metrics. We've got the price to earnings growth. So what we look at here is the earnings per share prior year and this year. So if you look at the earnings per share for the prior year and you look at it for this year from the quarterly report that's available down the bottom of the income statement, and I just see if I can pull that back up again for you. So what I'm using these numbers here. So there's the earnings per share at the end of for the first 9 months of last year. Here's the earnings per share for the first 9 months of this year. So comparing like with like. So what we can see is the earnings per share has grown. And if we go back to here, we can take the growth rate, and therefore we end up with what's called the price to earnings price to earnings growth rate, so the PEG, and the lower that is, the cheaper the company is. So this looks on a PEG ratio relatively cheap. I've also done that to include the dividend yield, because it's not just capital growth, it's also the dividend yield that you're buying as well. Dividend yield is pretty small, but it still makes a difference. So what's known as the PEG-E ratio, the PEGY, and that's at 0.64. And there's also an additional ratio here, which is the share buyback yield, but they're not doing any share buybacks. So again, that actually hasn't changed at all. That's also 0.64. And really kind of the metric here is if it's the lower the number, the cheaper it is. If it's below 1, then it looks cheap. So I think from these metrics here, I think Ahmed is right. This is looking a pretty cheap stock, relatively speaking, and could well be an opportunity to buy into it. However, the caveat is always that Activision Blizzard, they live in a very fickle world. So it's not like Coca-Cola, where people just they just buy the drink and they carry on drinking it, and it's kind of like they make profits forever. Call of Duty is gonna go the way of Pac-Man, because the technology is changing. So you're buying into this company is buying into its ability to stay at the top of its game, to produce the really compelling. Now, they didn't produce Candy Crush, they bought Candy Crush. Now, I'm not saying that they can't do that in the future, but again, there's that fickle gaming world. Are these guys going to maintain that that kind of operating stratum? The simple answer is this: I don't know. You can see that they've kind of if you this is a chartist's approach here. So if you kind of look at their trading pattern here, effectively it looks like they're finding support here, and that they are looking maybe that they're going to kind of they're going to do this, and that's going to be the future. And that's very much again just a kind of a technical chartist approach to this. So it looks to me like they've got support. It looking like a quite a good company. I would not be adverse to asking Father Christmas to put a couple of shares in Activision Blizzard in my stocking this Christmas, Moe. Let's put it like that. So there is our analysis.
Yeah, I think this would be in the probably not safe, because no investment is truly safe, but certainly in the more stable part of the portfolio, similar to Abbott Laboratories, I think, that we looked at, which is a medical devices business, but slightly higher kind of dividend yields, and I think a better PE ratio or similar PE ratio actually from what we looked at. So that could be one that you as the viewers could want to look at. So hopefully this was of value for you. Like, share, subscribe if you find it valuable. Do let your friends and family know about this video if they're interested in either doing business with them, or if they're interested in investing with them and like to have some more information about the financials. And do leave a note in the comment section to make your request about a company that you would like us to analyze if you're interested in them. So do leave a note for us. But until the next episode, thank you again. Thank you, Ted, and we'll see you soon.
Okay, good to speak to you, Mary. Catch you later.